Assalamualaikum friends. Well, we are back with our IFRS refresher series, and today we are going to discuss IAS 8. In previous two lectures of our series, we discussed IAS 2 and IAS 7. Today we will discuss IAS 8 accounting policies, changes in estimates, and errors. We will be discussing the key definitions, accounting policies, accounting estimates, and accounting errors, and the respective treatment in financial statements along with their disclosure requirements given in the International Financial Reporting Standard. Well, accounting policies. What is a policy? Policy is the specific principle. It is the convention or rule or practice which is applied by an organization to account for certain type of transactions. For example, reporting your assets in your financial statements at cost or at revalued amount. So that is an accounting policy. A change in accounting estimate. Accounting estimate is basically related to we make certain estimates in our financial statements. For example, the useful life of our asset. For example, the net realizable value. For example, the expected credit loss, the realizable value of our receivables, the realizable value of our financial instruments, and certain other financial assets and liabilities. So in this standard, we are discussing uh, how to account for changes in accounting estimates. A change is accounting estimate as per standard terms is an adjustment of the carrying amount of an asset or liability or related expense. Why does it happen? It results from reassessing the expected future benefits and obligations associated with that asset or liability. What is material? Any information which in the financial statement can affect the decisions made by the user of financial statements based on the presentation of that information in a certain manner or omission of that information is known as material. So information is material if omitting, misstating or obscuring it could be expected to influence the decision that is made by the user of financial statement based on those financial statements. So what are prior period errors? Prior period errors are basically errors made in accounting for certain type of transitions in previous periods. So they are basically omissions or misstatement in an entity's financial statement for one or more prior periods, or which basically arises from a failure to use or misuse of reliable information that was available at that point of time and has been missed and has not been taken into account in those financial statements. So such errors result from mathematical mistakes or mistakes in applying accounting policies or oversight or misinterpretation of facts and fraud. So accounting policy, how do you know while preparing the financial statement at which accounting policy to apply? What are the sources of guidance? While you can take guidance if there is a specific international financial reporting standard which details that how a certain instrument should be recognized, measured and reported in financial statements. International Accounting Standard Framework, which define the basic concepts, the realization and measurement methods related to assets and liabilities, and income and expenses, and certain other guidelines. For example, Companies Act, SCCP guidelines, or any other relevant guidelines applicable in Pakistan, or if you are in any other jurisdiction, any other guidelines which are applicable in your territory. So, whatever accounting policy you use on similar type of transaction, you should apply the same accounting policy uh, to have the consistency in your financial statements and to avoid financial statements being misleading for the users of financial statements. And what about the changes? Any change in accounting policy is basically accounted for retrospectively. Why a change is triggered? It might be triggered if you are following certain international financial reporting standard and it has changed or evolved. For example, previously revenue was recognized as per IAS 18, which mentioned risk and reward, and now it is IFRS 15, which defines the transfer of control and five-step model for recognizing revenue in your financial statements. So when there is a change in international accounting standard, a change in accounting policy will be needed, and if there is no transition requirement given in that particular standard, then you have to apply the change retrospectively. If retrospective application is not possible from the start of those transition, then to the extent possible, and if it is not possible at all, then you need to disclose that in the financial statements. So other changes in accounting policy might be done by the organization if it feels that application of certain accounting policy will result in more meaningful information for the users of financial statement related to the business of the entity. So accounting. So let's put the next slide. So change in accounting estimate and errors. So accounting estimate, for example, let's say that previously you were depreciating assets on reducing balance method, or on, you think that straight line is more accurate reflection of your financial information, or for example you made a certain estimate about net realizable value. You are still measuring net realizable value, but there is a change in estimate related to the net realizable value of your stock. It is also known as a change in accounting estimate. So change in accounting estimate is applied prospectively. Whenever there is a change in accounting estimate, it reflects the measurement of event and transition in that particular period, and retrospective treatment is not required for a change in accounting estimate. However, for an accounting error, you need to correct the error in the period in which it occurred. So for example, if you're preparing financial statement for 2024 and the error occurred in 2023, you will correct the financial statement for 2023. However, if the error occurred before 2023, then you will restate the opening numbers of 2023 financial statement shown as comparative. And so for the user of financial statement, it will be clear that there was certain accounting error in prior period which have been corrected now. Let's discuss the disclosure requirements. For accounting policy, you need to disclose that why the change in accounting policy happened, what is the nature of accounting policy which have been changed, a description of the transition provision. If the new international financial reporting standard have been applied and there are transitional provisions, what are those, and how those transition will be recorded in future. Financial statement of the organization for each financial statement line affected, and for basic and diluted earnings per share only if the entity is applying IAS 33. The amount of the adjustment dated to the prior periods before those presented. For example, if you are preparing financial statement in 2024, you will apply retrospective, so you will adjust the opening of 2023 as well. So if retrospective is not possible, then apply it to the extent possible and disclose it why it was not possible. In accounting estimate, you need to disclose what is the nature of the accounting estimate change, what have been the impact on financial statement, and for example, to have an effect on the period, if the amount of the effect on future period is not disclosed before estimating, it is impactable when entity shall disclose that fact. So in the case of accounting errors, the nature of the prior period error should be disclosed for each prior period presented to the extent practicable. For each financial statement line affected and for basic and diluted earning per share, you need to restate those numbers, and the amount of the correction at the beginning of the earliest prior period which is presented for retrospective restatement, and if it is not practicable, why it is not practicable, and what was the amount at the start of the period beyond which retrospective application is not possible. You need to state that in the disclosures of financial statement in notes to the accounts. So we have discussed in brief IAS 8 today. If there are any particular question, then you can discuss with us. You can reach out to us on our given number and email address, and a link to my LinkedIn profile has also been given. We'll be more than happy if we can help in application of certain basic financial reporting standard concepts that we are discussing with you guys. Please stay tuned, and if you have not already subscribed to our channel, please subscribe and also press the bell icon so that whenever we upload a new video, you automatically get a notification. Let's learn together and refresh our knowledge and share our knowledge with each other. Thank you.